Sam Spinella, your real estate guy. I want to talk to you today about the new tax code and its impact on the residential real estate market. Please keep in mind, the following is not meant to be a resource for tax advice, but instead a resource for basic information concerning only certain aspects of the new tax code and how they may impact the real estate market. You should certainly get tax advice from your accountant or financial advisor who will explain how the entire tax code will affect your tax returns. So there's three major changes and three major proposed changes that were out there. Number one was changing the requirements for the exclusion of gain on the sale of a principal residence. It'll make more sense once we get into it if it doesn't make sense now. Number two, the reduction on the limit of the mortgage interest deduction, or the MID. And number three, the elimination of the state and local tax deduction, also known as SALT, which also includes property taxes. So first one, exclusion of gain on sale of a principal residence. So the original proposal was pretty drastic, actually. The original proposal was owners would need to live in their house for at least 5 out of the last 8 years to claim this exemption. Under the former tax framework, a typical owner who had lived in their house for at least 2 years out of the last 5 would pay less in capital gains. Well, what happened? So the new tax code is actually, there was no change. So initially it was 2 out of 5 years. They actually kept it 2 out of 5 years. Now what this means is that if you're an individual and you stay in your primary residence 2 out of the last 5 years, you can sell your home and you have no capital gains on anything that's up to $250,000 that you sell for, that comes into your pocket. And as a married couple, you have $500,000 exemption. So that means that you're not taxed on 250 as an individual. It means you're not taxed on 500,000 as a married couple. Now the next one, the mortgage interest deduction. Now the mortgage interest deduction, the original proposal was to reduce the limit on the mortgage interest deduction, or MID, from 1 million to 500,000. The new tax code, so they actually went straight in the middle on that one, and the new tax code is 750,000. So it reduces the limit on deductible mortgage to 750,000 for new loans taken out after 12/14/2017. Current loans up to $1 million are grandfathered in. And the last one is the state and local taxes, including property taxes, and this is the SALT. And SALT is, the original proposal was to eliminate the state and local tax deduction altogether. And the actual new tax code is, it allows an itemized deduction of up to $10,000 for the total of state and local property taxes and income or sales taxes. Now there's an asterisk next to itemized for a reason, because what's interesting is 70% of the US households do not actually itemize. So it's actually less of an impact than you would actually expect. So let me know if you have any questions. Again, this is all information. Talk to your tax professional, talk to your financial advisor, and how it's going to impact you specifically. Let me know if you have any questions. 408-393-9294. Hope you're having a wonderful day and Happy New Year. Take care.